As an investor, when should you start to shift from an accumulation-focused portfolio to a more retirement-focused portfolio? What needs to change in your allocation as you transition? There isn't a lot of great advice on this front, and it's an area I see a lot of retirees wait too long in making these transitions, leaving them open to unneeded risk. So let's give you a framework you can use. When you're in the accumulation phase saving for retirement, there are two things that matter most: savings rate and growth rate. The more you can save and the faster you can grow those savings, the better off you will be. You can afford to take on more risk and volatility in this phase. Say a 2008 market crash happens while working. In some ways, it can actually be an opportunity. You are still earning a living from your job, and your savings are buying into the market at a discount. Because of this, most academic papers show that you should be willing to take on more intelligent risk during the accumulation phase, with the idea that this risk is going to generate more growth. And by intelligent risk, I mean having more stock exposure, not investing in levered funds or some crazy alternative investment. But here's a problem we often see. Many workers will keep an accumulation style portfolio too close to retirement. For instance, say you are retiring next year and plan to transition to a more retirement focused portfolio at retirement. You may have the wealth right now to retire, but if between now and then the stock market drops 30%? Are you still able to retire? Or would you need to work longer and push back your plans? Could you even have the confidence to retire? This is the problem. If everything goes well, yes, you might squeeze a little bit more growth in those last couple months or even years. But at what cost? In some ways, this is akin to gambling your retirement date. Adding safety is critical to retiring with confidence. Here's an example why. When you're retired and withdrawing from your portfolio, you introduce a concept called volatility drag and sequence of return risk. Volatility is beneficial during the accumulation phase as you can dollar cost average in during points of high volatility. You're adding to your wealth. But the math changes in retirement. Losses hurt more than gains help. If you lose 50% of your wealth during a 2008, how much do you need to get back to break even? $100 turns into $50. Well, you obviously need to double your money to get back to break even. But what if you're in retirement and withdrawing through that downturn? Yes, the market will eventually recover, but in terms of the value of your account, your withdrawals are akin to additional losses. Say through withdrawing, your portfolio drops 60% instead of 50%. Well, now you need to make 150% to get back to break even. Again, losses hurt more than gains help. This is why safety is a must, so you don't need to further your drawdowns on the growth side of your portfolio through withdrawing from it. There's a lot of data that backs this up outside of just the theoretical context. Here's a chart showing safe withdrawal rates based on different retirement horizons as well as different stock bond mixes. What you'll notice is across all time horizons, the highest safe withdrawal rates are found with more balanced portfolios, not the most aggressive or even most conservative portfolios. If growth rate is one of the most important variables in the accumulation phase, risk management is the most important one in the retirement phase. To give you data from a slightly different frame of reference, for every individual, we can map out the theoretical importance of each year of investing. Let's use an extreme example and say your portfolio is either going to grow by 30% or fall by 30%. Well, in the first and last year of your investing career, returns really don't matter that much. Early in investing, you don't have enough saved up for it to really make a difference. In the last year, well, you don't need any more money after that year. So as you can see from the graph on the screen, the most important years are the few years prior and proceeding around your retirement date. This is when sequence of return risk is the highest and risk management is the most important. Now, the financial industry has a commonly used way of handling the glide path from an accumulation portfolio to a retirement one. In fact, there's a whole suite of funds called target date funds that invest based on this exact glide path. According to Vanguard data, 58% of company plan participants, like 401k participants, solely use these target date funds. Here's how they work. When you are young and you first start investing, you are very growth heavy. And let's say have 85% in growth and 15% in safety. I have no problem with an investor having safety at every age in investing, but if you are focused on the highest growth rate, I would argue the 15% safety at age 20 isn't really needed at this stage. Then at about 25 years out from retirement, there's a steep glide path where safety will be added each and every year regardless of market performance. It doesn't matter if the stock market dropped 50%, you are still going to be taking from growth and adding it to safety. Then even after you retire, this common glide path method will continue to load up on safety each year that you age. Now, this method isn't terrible. It does accomplish the overall goal we are trying to solve in this video of transitioning to a retirement portfolio. But it's not optimal. It's a model strategy where every situation is handled the same way. Anytime you are using a model cookie cutter strategy, It's not optimal, and you are the one bearing the cost of simplicity. So is there a better way? Well, let's look to the academic literature. There are dozens of papers on the topic of transitioning to a retirement portfolio. I have some listed here. Without going through each paper one by one, most of these papers point to the best strategy being to start transitioning 7 to 15 years out of retirement. Some will have a time frame as short as 5 years, some as long as 20 years, but most overlap on that 7 to 15 year time frame. Where things get a little bit confusing here is the right answer might change based on your goals. For instance, if you are very risk conscious, you might focus on the worst case scenarios. In this context, adding safety further away from your retirement date will be best. However, if you focus on more average or median trials, a shorter time frame where you stay growth heavy longer might give you the best results. So again, it depends a little bit on your risk tolerance, how you view this overall equation. But the general 7 to 15 year time frame, let's keep that in our minds for now. As part of your transition strategy, I believe you need to be dynamic. This is something missing from the traditional glide path. It's crazy to me to shift the same amount of safety after a year like 2008 as you would after a year like 2024. 2008 was a terrible year for stocks, whereas the market reached all-time highs here in 2024. We should be more comfortable adding safety at a market high than after a big downturn. But this begs the question, when is a drawdown too big to continue the transition? When should you forego adding safety in a given year or string of years? If we are a 0.5% off market highs, should we forego adding safety momentarily and then aggressively add more safety at a new all-time high? What about 20% off highs? Here's a chart showing annual market returns back to 1980 with the respective intra-year drawdown. Intra-year drawdown is the biggest drawdown from peak to trough experienced that year. It might surprise a lot of investors, but the average intra-year drawdown was 14% through this period, meaning it's quite common to be in a quote-unquote drawdown. My general recommendation would be to forego the shift to safety in a given year when the market is down greater than 5 to 10%. Again, you will resume the additions to safety plus that which you missed once the market finally does recover. But this can act as a trigger to avoid just naively glide pathing with no adjustment to market activity. Now, just as a broad disclaimer here, when I talk about transitioning to safety, I'm attacking this in what I would call a minimum context. If you are someone who wanted to stay growth heavy as long as possible, at a minimum, when do you need to shift to more safety? This might come off as me seeming like I'm super growth heavy, talking in this context. This is not the case. I have no issue with a 40-year-old who is investing in a 60-40 portfolio because it gives them more peace of mind. But this video is not really meant for that person as they don't need to transition to safety in the same way. So I'm focusing more on the growth side purely to meet the more growth-focused investors where they sit today. Given a growth focus, how much more upside is expected as compared to a more balanced portfolio on average? On the screen, I have 3-year rolling returns between stocks and a 60-40 portfolio. Not surprisingly, on average, you can expect a little more juice from a growth-heavy portfolio. Over these 53-year rolling periods, on average, an all-stock portfolio outperformed by 1.67% per year, with 72% of the time the all-stock portfolio winning out. This may lead a more growth-focused investor to believe that probabilities are on their side. Maybe it's worth holding an aggressive portfolio longer than the 7 to 15 years transition that the academic papers note. I personally would draw a different conclusion. Too many people focus on frequency rather than magnitude. Yes, a more growth-focused portfolio wins most of the time, but what does it cost you when it doesn't win, when it isn't a wise idea? I personally believe earning 1.5% more per year on average is not worth the risk of having to delay retirement in the big risk scenarios. But again, that's just my 2 cents. So given all this data and information, how should you handle the transition to a more retirement-based portfolio? I would caution against big changes. For instance, going from 100% stocks to 60% stocks overnight introduces a ton of timing risk. So a glide path does make sense. It's just overkill to have a 25-year plus glide path. The simplest way to handle this is a straight line glide path. Depending on your current portfolio, the retirement portfolio you are trying to get to, and the time frame you choose to get there, you simply do an equal glide path each year. On the screen, I have a 90-10 portfolio going to a 55-45 with 7 years to get there. Given this person is adding 5% to safety each and every year. Notice between years 4 and 5, there is a market downturn. Given what we've already covered, one would ignore transitioning to safety this year and instead make a bigger adjustment the following year when things recover. Again, this is a stupid simple method, but in my opinion, much more advantageous than the target date method. The way we look at handling it here at Safeguard is a bit more complex, but we believe you are ultimately paid for that complexity. I'm not a big fan of model portfolios, like everyone should be a 60-40 investor in retirement. The best results come from a personalized approach, and reams of research show this. Within this effort, we use something we call a liquidity plan. Take something like a 7-year transition period. Within a liquidity plan, we would forecast out your income goal and taxes about 10 years into the future. We then subtract out guaranteed income like pensions and Social Security. From here, this gives us your year-by-year portfolio need, rather than just picking a random amount to keep in safety like 40%. What if we match the safety to your needs? Remember, this is the chief reason we need safety in retirement, to fund withdrawals. So it makes a lot of sense then to match the safety to those withdrawals. If you need $67,000 of portfolio withdrawals in the first year of retirement, then this should be what we have in safety for that given year. Keep in mind, one can also build in a little bit of a buffer if you believe your spending might change or be more volatile as well. So we would build this liquidity plan out for a 10-year period. If we wanted our transition from an accumulation to retirement portfolio to be a 7-year transition, then if we're 8 years away from retirement, we effectively do nothing. We keep that accumulation focus. But next year when we are 7 years away, we would add that first tranche of safety that we would need for year 1 in retirement. Then next year when we are 6 years away, we would add the corresponding amounts for year 2 of retirement, and so on. We effectively step year by year and maintain that 7-year safety tranche. The same approach can be used in retirement as you adjust allocations annually as well. Okay, great. So stocks grow 20% a given year. How should your allocation change? We believe the answer depends on your plan and risk tolerance as a secondary metric, which causes us to go back to the liquidity plan to give you an answer. Again, this is better than just simply rebalancing back to a static 60-40 portfolio each and every year, or whatever model portfolio you are using. So there are a few ways to tackle the question of when to switch to using a more retirement-focused portfolio. Here at Safeguard, we believe the commonly used approaches can be improved on, and hopefully this video showed a few ways to accomplish this. If you're looking to learn a bit more about the massive transition from working to retirement, click here to learn why the first 5 years of retirement are your most important. Click here to learn more, and always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.